Very good evening, everyone. Very good evening to all our esteemed clients. A warm welcome to the ninth edition of Alpha Manager Series. This is the third series for this fiscal year. My name is Shulin Kamath. I'm a part of the investment functions team with InCred Wealth, and I'll be the host for today's session. I'm a part of the InCred Wealth Group, which manages close to 35 odd thousand crores of AUM across 4,000 odd clients. We are a part of the InCred Group, a diversified financial services firm and one of the fastest growing NBFCs in the country. To start with, if you have looked at the last 9 odd months, they have been anything but normal. We have seen bouts of volatility, particularly emanating from the geopolitical tensions, the Indo-Pak war, Middle East, Russia, Ukraine, all of that, the Trump tariffs and counter tariffs, and now to add to it, the one big beautiful bill have added on to the market volatility. Tweaks by the central banks, policy changes, monetary policy measures, have all kept the investors guessing on the next set of move. So in the midst of all this uncertainty, what does generally one look for? One generally looks for growth, and one generally looks for the inner strength coming from self-reliance, domestic consumption, make in India oriented themes. And generally speaking, the tier 2, tier 3 consumption focus sectors, particularly the electronics and electrical, manufacturing, textile, pharma, chemicals, food processing, all of these sectors have been a significant contributor to the Indian economy. So on that backdrop, InCred Wealth brings to you the latest edition of Alpha Manager series, and the topic for today is Before the Bell, Accessing the IPO-Ready Gems, with our guest speaker, Mr. Nishad Khanolkar from the Pantomath Group. Mr. Nishad Khanolkar currently manages close to 8,000 odd crores of AUM across the 4 series of Pantomath, which is Pantomath Bharat Value Series. The series is focused on identifying fundamentally strong companies which are undervalued in nature, and which are likely to get IPO'd over the next 2 to 3 odd years. They specifically target the tier 2, tier 3 firms which are in their growth stage with a consumption, make in India and impact investing kind of themes. It's one of the very few products in the market with a very aggressive hurdle rate of 15 odd % and a tenure of roughly around 5 odd years. So a very strong differentiation seen as far as the product is concerned. It's a pleasure to introduce the speaker for the day, Mr. Nishad Khanolkar. Nishad has close to 22 years of experience in investment and fund management. He was the ex-CEO of SP Growth Partners, an AMC based out of Hong Kong. And in his previous 2 series, which is Pantomath Bharat Value Series 1 and 2, he has clocked close to 40 odd percent XIRR returns. He's the founding member of the investment team with Pantomath and a chartered accountant by qualification. So welcome on the call. The way we have structured this particular session is the next 30 odd minutes is reserved for Nishad to take you through the salient features of the product and highlight the suitability of the product, and maybe the last 10 to 15 odd minutes are reserved for the Q&A session. Let me tell you, the Q&A tab is you can see at the bottom side of the window. So please feel free to log in all your queries and questions to Nishad, and he'll be happy to answer all of them. So over to you, Nishad. Over to you for highlighting about the product and the suitability.
Thank you, Shulin. Am I audible and my screen is visible? If you can confirm.
Yeah, it's perfect.
Thank you, Shulin. First of all, Shulin, thanks a lot to you. I'm sure there are various fund managers who are behind you to get an kind of an appointment or a slot for this event, but you gave me an opportunity, so really thanks. So as you have requested, yes, I will be presenting the presentation along with my senior colleague Dashnik, who heads my business development over a period of next 30 minutes. Whenever we give the presentation, we always give it in a pointers format. But before that, a small disclaimer. I would like to structure this event or a presentation as a part of education or a investor awareness. This is not to market anything because this is a SEBI registered product, and so I would like to keep it as an investor education and awareness seminar. So we always give all the presentation in a pointers format, and I would be giving my presentation in 3 or 4 parts. The first is background about the group. I personally believe the background of the group is very, very important to achieve the success of the fund. So in that part, I'm going to tell you who are the driving factors who are supporting the success of the fund. That's point number one. Second point, the positioning of the fund, where exactly the fund has been positioned. Once I explain that, I guess 70-80% things would be clear. The third point, where do I exit? Where do I enter? How do I make money? And then last thing is of course Q&A, which we are going to cover. So Shilin, I always say that the first thing first, that whenever you're investing in any fund, you should always look at the background of the group, because a sole fund manager can never operate the fund. So Bharat Value Fund, be it Series 1, Series 2, Series 3 and Series 4, we have a strong 4 pillars, which are them. So first part is the Pentomath Group. As you all know, Pentomath Group is India's largest mid-market merchant bank. Pentomath Group knows how to take a mid-sized company to the IPO. As a Pentomath Group, in last 11 and a half years, we have executed 114 IPOs. So that is the background of a Pentomath Group. So invariably, when you do the IPO, Shulin, also you also know that whenever you do the IPO, the 30% of the IPO lot has to be mandatorily subscribed by the anchor investors, mutual fund, insurance and bank. So invariably, India's reputed anchor investors have invested in the IPO where Pentomath has acted as a merchant bank. So that's the quality of the Pentomath. First of all, to clear the compliances, and second thing, to attract the good anchor investors on your portfolio. So that's about Pentomath Group. As we all know, Pentomath Group also has is also the owner of 53% stake in Asit C. Mehta. Asit C. Mehta was owned by Deena Mehta. Deena Mehta was the first and the only lady chairman of Bombay Stock Exchange. So what Asit C. Mehta has given us, they have a 42 years old legacy and they have excellent institutional network. So because of that institutional network, the kind of anchor investors who are getting attracted in our IPO, that has the quality of the anchor investors have gone phenomenally high. So when we started the first fund, Shulin, we had only 2 support system, and that's where the improvement and improvisation comes. That is Pentomath, which was probably excellent in India till the date of IPO, taking mid-sized company to the IPO. And Asit C. Mehta was excellent, I would say, the post the date of IPO. That's where we started the Series 1, Series 2. And then we quickly realized that in today's market, if you wish to grow business, Shulin, it could be anybody's business, your business, my business. If you wish to grow, you need to have the support of artificial intelligence. And without support of, so as a fund, we may or may not invest in artificial intelligence. That's a separate call. But as a group, we have 2 good investments into artificial intelligence. So Analyst.ai is the analytical app owned by us. How does it support? So the theme of the fund is very simple. Invest in those companies which are IPOable in 3 to 4 years time. So when you invest in a company, invariably promoter takes your money and start chasing the revenue. That's a natural mindset. That is, of course, that is the reason why you are given money to the promoter. But when promoter starts chasing the revenue, by default, he attracts something called as a bad debts. Now, as a fund manager, how do you expect you to get into the day-to-day operations of the company and stop those bad debts? Relatively challenging hai. So Analyst.ai plus, whenever I'm investing, invariably आप देखिए, so most of the time the fund houses take 2 years, 3 years, sometimes more than 3 years to deploy the money. Whereas historically, our Series 1, Series 2, Series 3 have deployed most of the capital in 8 months, 9 months. Why this is possible? Because the due diligence is equally faster. So Analyst.ai is such an app where very India's unlisted company, you shouldn't talk about their GST default, TDS default, criminal liability against the promoter, any charges against the company, entire analytical report comes to me in 10 to 15 minutes. So how does it help me? As a fund manager, even before meeting the promoter, I come to know should I meet them or should I not meet them. So my due diligence become faster. And not only that, my investee company, imagine the purchase manager or the CFO of the investee company has that kind of a tool. Tomorrow, if my investee company promoter or a purchase manager is subcontracting something with some other vendor or is taking a credit call on somebody else, Does he really know the credit worthiness of that particular person? The probability is not. So analyst.ai invariably is an analytical tool which helps you in identifying the danger coming to your way much in advance. So that's the analytical support. And the last support is leads in. As the name suggests, it is the lead generating ability tool. So lead Zen helps you in providing the data, not only the money. Money, of course, fund manager has to give me. But beyond money, if the promoter wants to grow the business, see in today's business world, if you want to grow your business, you need to have the leads. You need to have the data points. And those data points are provided by the lead Zen. Sorry to say, in most of the mid-sized manufacturing companies, which is my catchment area, they do not have the analyst AI support. They do not have the leads and support. So because leads and support is not there, growth becomes difficult. And because analyst.ai is not there, most of the time you see there are good balance sheet and they take one wrong credit call. Sure, in one wrong credit call and sometimes entire profitable balance sheet turns from green to red. So that's where analyst.ai comes into the picture. So as a fund manager, I explained you that these are my four support system. Now let me tell you what promoters look at this. So when the investee company promoter comes at us, they look at this picture or this particular slide. Why my deployment is faster? It's not only because I want to invest in the investee company. The promoter should also be willing to take my money. And if promoter has to be willing to take my money, promoter look at this slide as a one-stop shop. Okay, from tomorrow onwards, promoter has to do only one thing in his life, that is called growth, that is called business, that is called his day-to-day operations. Pentomet Group will help him in clearing his compliances. Asit Mehta will help him in post-IPO scenario. Analyst.ai will tell him the danger coming in his way in credit acceptance. And Lead Zen will help him in providing the data. So this fund house is lot beyond vitamin M. This is not only a fund house. This is lot beyond vitamin M. So why my deployment is faster? I am answering that question in a one slide because this fund house believes in giving a one-stop shop to the investee company, of course the promoter. So that's the background about the group. We have a 7th-floor building, Shulin, very near to your office, which is at Andheri Sakinaka, owned by us. We are 357 people working from the same premises. So that's where our whereabouts are. Shulin, now first part is over. I given the background about the group. Let's go about the second part, which is very important, the positioning of the fund. Very softly I mentioned during my first 10 minutes presentation, the positioning of the fund, be it series 1, series 2, series 3. The series are only for the sake of namesake, but the concept remains same. And that is, Shirin, if you ask me, Nishad, complete the presentation in 1 minute. What is your background? What is the fund theme? Is very simple. Invest in those companies which are IPO-able in next probably 3 years time. Frankly speaking, Shirin, there is no presentation beyond that. Now what I'm going to do is slightly go into deeper aspect of that. Shirin, I always believe this is a life cycle of any particular company. Again, this is only and only for the education purpose. Shulin, this is the point of IPO. The left side is the pre-IPO, right side is the post-IPO. I'm still on my exit only. So, Shulin, very clearly, what has happened is that over a period of time, the Pentomet Group has done so many IPOs. So probably the liking or the tick mark of the mutual fund, insurance and bank, basically the anchor investors, we have learned it a very hard way. So what we are trying to do, see the anchor investors, the balance sheet size of anchor investors or the AUM of anchor investors is definitely going to go over a period of time. 25,000 crore check, they get SIP money at the start of every month. This is the unlisted market. Unlisted, they cannot invest. Outside country, they are not investing. The earliest point they can invest, Shulin, is the point of IPO. Now, coincidentally, Shulin, that point became my strongest point. So, each and every company I invest, the shareholders agreement has a clause that as a fund manager, I have right to get out on the date of IPO. Any company, say I'm going to give you 3 points. I'm saying I'm only sticking to the exit. Entry, I will come a little bit later on. Most of the people say the post IPO scenario is a liquid market. True and false both, may or may not be. Small amount of equity you can sell, but a large amount of equity, if you have something say 15% or 10% or 12% stake in any company, selling it post IPO can become challenging. But IPO is the most liquid event in the history of your company. If you ask any listed company CFO or promoter on what date your stock was maximum sold, point of IPO. So be in a position to get out on the date of IPO, because on that day, first chapter of economics, demand supply is going to be your favor. So that's the shareholders agreement. We have right to get out on the date of IPO. Second point, most of the people may not appreciate it, but try to get out within budget of India. If you really see, India is a market where preferably we see that the IPOs below 8,000 crore, 10,000 crore are relatively more successful as compared to the IPO above 15,000 crore. India has not witnessed too many successful IPOs about 20,000 crore in last 5 years. But on the flip side, how many IPOs below 8,000 crore India has seen successful in last 3 years? The answer is more than probably 150 shilling. So what I'm trying to do, I'm simply playing the demand supply game. I'm not playing anything high tech. The demand supply is basically on the date of IPO, demand supply is in your favor, point number one, because that is the most liquid event. Demand supply is in your favor. Second point, try to exit within budget of India. Do not try to sell a too big thing into India. 8,000 crore, 12,000 crore is a easily exitable opportunity. Do not try to chase a too big dream. You can make money in that valuation also. And third, probably by hard way, we have learned to do how to do the IPO. So that's in our blood. So that is the three reason why I am harping harsh upon exit, 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 and exit only. So this is an exit oriented fund. Enter the company, nurture the company, exit the company are the three fundamentals. Probably we spot the exit first. If there is an exit opportunity, then only we enter. So now, Shirin, after speaking with you for 10-15 minutes about exit, 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 now I'm coming to the entry. So what we try to do is basically the selection parameters of mutual fund, insurance, and bank are mirror reflected in my selection parameters. So what is the easiest thing you can sell on the date of IPO? I'll tell you. There are only 5 parameters. Maybe 1,500 crore turnover, point number 1. Preferably, I'm not against software, fintech, IT company. They are also good. Preferably asset-backed company, point number 2. Third point, most important, PAT positive company. Fourth point, promoter himself is having substantial shareholding. He is not exiting so easily. He is holding good amount of equity with him. Point number 5, his second generation is into the business, so that there is a longevity to the business model. And most important is, of course, the compliances are well placed. Shirin, if you try to bring such kind of a thing into the IPO market, what are you trying to do? You are trying to hit the safety quotient of be it HNI, be it retail investors, or be it a CIO of any anchor investors. Every investor has two brains, the left and the right. One is a safety, one is aggressive brain. Hit the safety quotient of the investors, which is anchor investors who are willing to buy your product and exit your product. So that's why I said the selection criteria of mutual fund, insurance, and bank, I have a mirror affected in my entry level. So I also enter in the same companies. So now I'm coming to the entry. So where have I invested till today? So if I take the chart of the series 1, series 2, series 3, Shilin, 85% money I have given to asset-backed companies, point number 1. 88% money I have given to PAT positive companies. 95% money I have given to the promoter, 100% money I have given to the promoter, where before my entry, promoter was 100% shareholder. So what I try to do, a reasonably grown up company, not a startup. I'm not against startup, that's a different ballgame. But can I take startup to IPO in next 3 years, 4 years time? A slightly challenging question. So in my business model, neither you have a challenges. I am not using the word risk, I am using the word challenges. Neither you have the challenges which are faces in startup, nor do you have the higher valuation which you technically hit after the IPO. In between that, so you have the mix of both the worlds. So your company is grown up, you have something to check, you have balance sheet is there, auditors are there, you have everything is there to check, but at the same time you are not giving higher valuation because the company is not listed. That is where I say that the exact epicenter of both the worlds. So what I try to do, a reasonably, now I'm coming to the entry, I have explained the exit. A reasonably grown up company which has done say 600 to 1000 crore turnover, as far as possible till today I have tried to become a first institutional check cutter. Before me, VCP were not sitting. So technically, if VCP is not sitting, you are not buying a costly affair. So try to become the first institutional check cutter. If promoter has not diluted his equity, needless to say, his family money stuck up in a business. Give money not to the promoter but to the company. That's called primary investment. Give money to the promoter. So my arrangement with the promoter is take my money, take my artificial intelligence, take my corporate governance, take everything from me. Next 3 years, try to raise that revenue bar from maybe 700, 800 crore to 1500 crore. Meanwhile, I will help you in clearing your compliances. So relieve promoter of all the responsibilities. Promoter should be given only one and only one task, and that is, in Hindi we call it as Dhanda karo. In English, we call it as grow your business. That's the only one point agenda given to the promoter. Then you see how these mid-sized companies grow because they have already learned how to do the business. I'm not reinventing the wheel. They know how to do the business, and that junction we are giving him the money. So try to become the first institutional check cutter, and from there till the IPO, preferably try to lock the cap table. Not too many investors. Still, in all the companies I have invested till today, not even a one company has more than 4 shareholders. So what are you doing? If you try to restrict the number of investors on the cap table, whenever the IPO comes, technically you stand first on the exit door. So it's not only about knowing the exit, it's about knowing the entry and controlling the cap table. I always say, if you do not have the control over cap table, whenever the unlisted company goes for the IPO, the promoter himself doesn't know who is exiting, who is entering. So if you have the control over the cap table, invariably, whenever you exit, you would by default stand first on the exit door. So that is how I explained the entry and I explained the exit also. I also mentioned where I have invested till today without giving any. So this is a sector agnostic fund. All sectors are good. No investee company I have taken a bet more than 10% of my corpus. So there is no concentration risk. No sector has I have taken exposure of more than 15%. So neither a sector exposure is there nor a company exposure is there, because in the event, instead of taking all the checks and balances at any point of time, the Mayday event can happen. If the Mayday event can happen, only thing can help you is your concentration risk. And my concentration risk in one investee company is not more than 10%, and in one sector not more than 15%. So there I am helping myself and fund and of course the investors by not taking too much concentration risk. Shirin, the next slide is very important, and I'm openly going to tell you that whenever any investee company comes for our review, these are the selection parameters. Actually, those are reviewed by the IC committee, which is of course 4-member IC committee, and these are the selection parameters. So for all the viewers, if you like that this is a kind of a selection parameters that mutual fund, insurance, bank would buy, the fund is for you. But if you say no, this selection parameters are wrong, then of course needless to say this fund is not suited for you. So the first IC committee, the selection parameter, the point number 1 is IPO conviction. Again, the entry itself has exit. That's called staying in this market for 11 years, doing 114 IPOs. And on my IC committee, Prasanna is there. Who was Prasanna? Prasanna was the CEO of a Taurus mutual fund. The CEO of a mutual fund is sitting on my IC committee. So any investee company. So I have not only created my background, my entire work experience into IPO conviction, but even the shareholders agreement does speak about IPO conviction. The very non-negotiable clause we have in all the investee companies, the day I give the money to the promoter has to go for IPO in 30 or 36 months. This is a non-negotiable clause. Many investors of my fund have asked me, should promoter negotiate with me on this clause? Probably I will not go ahead, irrespective of the fact the company might have passed all other litmus tests. So IPO conviction is the first, because in unlisted, the most important point is you exit, you will make the money. Unlisted will give you more money than the listed, provided fund manager knows how to make an exit. And this is called exit. My first selection criteria, while I was speaking, I was also talking about the exit. My selection criteria also starts with the exit only. Second, straightforward businesses, no complications. Why? Again, many people say I'm against software. No, I'm not against software. We have invested money into software also. In fact, my most growth company is software company only. They have their profitability of the company has gone up by 92% in 1 year. This is the most profitable company, software company only. But invariably, you know what happens when you come for exit? We commonly say in Hindi, "Jo dikhta hai wo bikta hai." In English, we call you buy what you see. So asset-backed companies are relatively easy to explain it to the investors. And when it is easy to explain it to the investors, it becomes easy to exit also. That is the whole reason why I have taken 85% exposure into the asset-backed company. Again, I put a disclaimer. I am nowhere saying I am against software. Many investors do come and ask me, are you against software, fintech? No. That's a wrong statement. But I have invariably taken more bet on the asset-backed company. And I have taken bet in software. The next investing company is going to come from non-asset backed company, highly profitable company is going to come in series 2 or series 3. Shirin, this is very important factor. Regional brand going to national brand. Shirin, there is only one way you can make money in fund management, and that is called enter low. There is no other way. You cannot sell something at a higher cost, but you can make money by entering at a low. Now, how do you enter low? So you see all my investee companies, Shulin, you know all my investee companies by your first name. Invariably, all companies have the regional brand. So when you invest at a regional brand, give promoter money, give promoter artificial intelligence to grow the business, give him the brand ambassador. So enter at a regional level, exit at a national level. Most of my investee company have the brand ambassadors from a Bollywood and a cricketing fraternity, but they came post my entry. So you enter at a regional level and exit at a national level. This is a very important point. Between entry and exit, whatever profit you earn, of course that you're going to earn, but because of brand valuation, you make extra money. But should you invest, entry is at a national brand, so you are buying it costly. If you want to enter low, because enter low is the only way you can make money in fund management, you have to buy at a regional brand, help that brand to grow at a national level, and that's where you can exit. I would say when I speak to most of my investor base, today we have investor base of close to 2,700, 2,800 investors. Dasni can correct me if I'm going wrong. Growth capital is the most interesting factor in this fund. See, the point is, most of the unlisted stock we see are trading secondary. In secondary, we are just exchanging the hand among the investors. The company is not getting money. Whereas this fund has invested more than 85% to more than 90% is growth capital. It is primary. For a layman, secondary means you are funding the promoter. Primary, you are funding the company. If you are giving the primary, the company has 12 machines. Tomorrow it will become 20 machines. Moment 12 machine become 20 machine, you're increasing your profitability, you're increasing your sales, everything increases. So this fund house has very rarely given a secondary. Always and always we are given a primary, meaning growth capital, and that where. So actually we are in a race to increase the balance sheet size of the company. We are not chasing the valuations. Because if you increase the balance sheet size of the company, valuations will chase you. Never chase the valuation. Valuation, today it is up, tomorrow it will go down. It is not in control of anybody. But increase the balance sheet size. Most of my investee company have double or triple their profitability in 2 years' time. Why? Because I have given the primary growth capital. Had I given secondary, no, the growth would not have been happen. So that's the very important point about the growth capital. Next point is substantial promoter holding. We always say, this is my first learning in private equity, which I received 22 years ago, and that statement is, mind mapping is more important than the watertight agreement. Mind mapping is more important than the watertight agreement. If promoter is having 90% stake, his second generation is into the business. He has never diluted his equity. He is paying his taxes on time. He has shown profitability. What does this mean? He is there to play a long-term game. That promoter ditching your, that promoter's company going down, that's an absolute rare possibility. That is where my entire emphasis is on promoter shareholding, substantial promoter shareholding. The delay can happen 5-6 months here and there, but failures can be avoided if you stick to this principle. That's where substantial promoter shareholding. Plus, whenever you exit, you're not facing the competition on exit. If you have too many investors on your cap table, and if the exit scenario happens, so it becomes the bottleneck. Wherein in all my investee company, I'm standing first on the exit door. But that's where the promoter substantial shareholding comes into the picture. Margin of safety, sir. You take any of my investee company. I have invested in the straightforward businesses. Each and every investee company has a listed peer. You open their listed peer, you check my entry P multiple. I'm talking about the P multiple. You will easily find a gap of 30%. So Shilin, if you look, where do I make money? I have explained exit, I have explained entry, and I am going to tell my selection parameter. This is my selection parameters, has the formula for money hidden. There is only one formula for valuation, which I believe, and that is PAT, profit after tax, multiplied by the P multiple is equal to valuation. There is no third formula. So by giving growth capital, I am giving and allowing you to increase the PAT. If you do the secondary, the growth capital, the PAT goes out of the equation, then you are relying only on the P multiple. And beyond the point, P multiple is not under control of fund managers. It can go up, it can go down. So to increase the PAT, growth capital helps you. And listed to unlisted, the liquidity discount changes. Once your unlisted company become listed, the P multiple goes higher. So this is where I increase the A, which is PAT, and this is where I increase the B, which is called P multiple. Double the PAT, double the P multiple, by default valuation goes 4 times. I am not saying this fund is going to give you 4x. That would be a wrong assumption, though the series 1 technical XRR, as you rightly said, is at a gross level of more than 40%. Series 2 also trading at the same level. Series 1, the MOIC is more than 2.6x That is 1 crore has become 2 crore 60 lakhs within 17 months of a final closure. But that's all the numbers. The concept here is increase the PAT by giving the growth capital, and unlisted to listed, you can make the margin of safety and you can make the P multiple growth. Check cash burn. Whatever investment we have done till today, I see most of the unlisted company nowadays they are issue with the EBITDA, but this fund house has given more than 88% money to the PAT positive companies and proven track record. Most of my companies are having a good amount of history. So you can see my most of the interviews 3 years ago when we started this fund, we used to say the same thing, and today we are saying the same thing. So this is walk the talk. Series 1, Series 2, all my investing company have invariably given the growth capital. Promoter shareholding more than 85% is 100%. First institutional check is 100%. PAT positive companies are 93%. Asset back is 100%. So this slide is called as walk the talk. We are not only speaking, whatever you can, anybody can open my interview which I have given 3 years ago, and this is the selection parameters. So left side is the selection parameters, right side is the walk the talk, which is this is where we have invested. So that's where I believe people have liked our fund. Shilin, just to summarize, Series 1 it took us almost 18 months to raise 500 crore. It was a nightmare, Dashnik being the head of the business development. Today is laughing, but it was a nightmare for him to raise the fund. But when we gave the good return to the Series 1, the Series 2 was relatively easier. The Series 2 we could raise within 4 months only 2000 crore, and Series 3 is almost 2500 crore. As we speak, as you all know, SEBI allows only 999 investors to onboard. Series 3 we are already close to 950 odd investors with 1700 crore commitment. And very few points, Shulin, I'm going to summarize. I've made a small Word document just to help for investors to understand. Before that, Shulin, I want to tell about the board. So this is the IC committee. Madhu is a rank holder chartered accountant. She was the youngest CFO of Edelweiss Asset Management. My background Shulin has given. So Madhu and me both started the Series 1 together. As we grew into the Series 2, Prasanna joined us. Prasanna was the CEO of a Taurus mutual fund. So again, you can see the IC committee comprises of the mutual fund experts. And now in Series 3, we have Series 4, we have joined the Tejas. So this is the IC committee. Madhu's responsibility is more from the point of view of helping promoter to do only one thing, that is called business, and relieving him of all the pressures. My point is setting up the MIS of the investee company, because that's where the real growth is. Prasanna probably knows the exit market best amongst the four of us, and Tejas' role is helping promoter in executing the business plan. So see, we are not only giving the money to the promoter, we are giving them the IC committee member is helping the promoter in executing the business plan. That is also very important. We have a very, very, very strong board. So 3 guys on your screen are the IS officers. They are representing our board, and 3 guys on your screen are the right guy is the IRS officer, and 2 are industry veterans. So board itself has having the collectively more than 200 years of experience, and IC committee every quarterly meet the board. They are independent directors. And when we started the Series 1, we did not have the proper board, big board to show, but now as we are growing in our businesses, so we have a proper board to say. Not only that, sir, you can see Mr. Saro was the first employee of Reliance Retail. What is he doing? As I said, most of my investee companies have the brand. So today Saro is helping all my investee company to develop in their brand and positioning their brand. Today he's taking investee company promoters to Dubai so that their product can be sold on their own markets. So that's where he was the first employee of Reliance Retail. So he understands the retail background very well. We have Vikas, who is on a Singapore feeder fund. He is also having the great connections with the Singapore Traders Association. And Mr. B.Y. Joshi, he was the earlier chief operating officer of 361. Now he is our chief operating officer. So Series 1 started only with couple of handful of names like Nishad, Madhulunawat, Dashnik, Prakash. Now we have a big team to show. So we are not only grown in AUM or the numbers or the returns and IRR, we are also grown in our teams also. So that's the reason, Shulin, I wanted to show the team. Shulin, before I go for a Q&A, I'm going to end the presentation in next 3-4 minutes. Dashnik has made one presentation summarizing what people liked in my fund. So wherever investor invest, this is only an investor's education and awareness. These are a couple of 8 or 9 points what investors do like in our fund. Faster turnaround. If you see most of the private equity fund, they are 7 years, 8 years, or maybe more than that. This fund is only 5 years from end to end. The third series has already begun on 18th January 2025. So your 5 years period starts from 18th January 2025. Plus cash flow point of view, as I said, the promoter has to go for IPO in 30-36 months. So cash flow point of view, this is 3.5 years fund. Regulators point of view, the first entry and the last exit, this is 5 years fund. High conviction, you have only covered this point with a hurdle rate of 15%. Series 1 was hurdle rate of 10%. Series 2 was hurdle rate 10% compounding. This series rate is not only 15%, it is 15% compounding, and I believe that is highest in the history. That shows the confidence of a fund manager. Most of the companies are asset backed, PAT positive, substantial promoter shareholding, right to do the IPO in 36 months, entry level value arbitrage. These are the point where most of my investing company carries this point, and this is what people have liked. Next is exclusive deal flow. Shulin, there are various unlisted stocks which are traded into the market. I'm not here to say whether that is right or that is wrong. That's not my core competence also. But invariably, I have never touched them. But at the same time, whatever investing companies are with us, you will never find them into the market. So that's where most of my investors like about the exclusive deal flow. Plus, we do give the co-investment opportunity whenever my investing company goes for a up round or a higher or next series round. I do give opportunity to my fund investors. So they have, look, come and invest. I have already taken the bet. You can take the bet. At least you know who is playing on the turf, who is the captain. That clarity is there. Who is going to exit, at what valuation you are entering. So that information you have.
Plus, no
Catalyst
fees
for
are
growth.
charged.
This
There's
is
no fee charge.
yeah, there is no free charge. Absolutely. Catalyst for growth. So this is very important. Secondary trading and primary trading. Secondary trading, sorry to say, you are invariably speculating. Do the primary. Primary investment, even if the P multiple market goes up and down, my primary investment can help me in growth of a PAT. Entry to exit in our funnel. We know how to enter also. We know how to exit also. Sixth point. So that's where the fund is important. Deep sectoral expenses, of course, most of the fund managers have. Control over cap table, eighth point. Cap table control is very, 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 very important. If you do not have the control over the cap table, that is the shareholder table, might as well plain listed. So most of my investing company, we do have a strong cap table control. Alignment with the founders, my first slide, promoters find it as a one-stop shop, and that's where my deployment is faster. Why? Because alignment with the promoter, my very first slide. Sector agnostic, we have not taken more than, this is not a one sector focus fund, never taken more than 15% exposure in one sector, and never taken more than 10% exposure in one investing company. Robust exit track record, Sholin, you covered at the start, strong governance, and of course the previous series we were trading at a very good IRR. So this was just, again, this is only an educational purpose, but these are the points investors do consider while investing in our fund. So Shilan, I'm not sure whether I have taken extra time, but I think we can open for I think I took 3 minutes extra. We can open for a Q&A, and
Okay.
anything you wanted to ask, or Dashnik, if you want to add anything, you can add. You're on mute, Dashnik.
No, I think you've covered everything, so we can open the floor for question.
Absolutely.
Then we can cover the remaining part.
Yeah, thanks, Nishad, for those insights. The floor is open for questions, everyone. Feel free to log in the queries to Nishad, and he'll be happy to answer all of these.
Shilan, before I
yeah,
wanted
sure.
to point out one thing. The series 3 is open under Gift City also. So Gift City is a feeder fund to the Indian parent fund, and I am the investment manager for the Gift City is managed by Wealth Company only. So it's not a third party managed fund, it's managed by us only. So all the overseas investors who want to onboard, if they have issues with it, because if you want to invest in India, you need to have PAN and demand. But those who want to come through Gift City, the minimum investment in Gift City is $150,000, and they will have the parallel drawdown like the parent and with the same terms.
Sure. Yeah, so the queue has already started building up. The first question is from the minimum investment point of view, right? So you just mentioned that you are close to 950 odd investors, right? And regulatorily you can go only up to 1,000 odd. So at this point in time, what's the minimum, investment, Nishad?
So series 3, we have the investment ticket size is slightly higher, Shulin. We are trying for at least 10 CR upward checks. And series 4, we have recently started where the 1 week ago, where the first 350 investors would come at a 1 CR. And I guess 100 tickets are already occupied in last 1 week. So series 3, series 4, frankly, there is no difference. Timing wise, one series is running ahead of second series. And the gift city is $150,000. So that's the ticket size.
Sure.
Different fund has a different ticket size.
Sure. Given that this is a cat to AI, right? The taxation angle also is very important for the investors, right? So could you please highlight some of those aspects?
Yeah. Sorry, I should have covered that. Very good point. So basically, there are two. This is a equity taxation. So I would say, as per today's law, because the taxation will affect and the date of exit, whatever the rules. So today is showing the long term is 12.5% plus surcharge GST. So long term is 12.5%. You enter unlist, you exit list after, or you enter unlist, you enter unlist only. The long term is 12.5%, but long term is 24 months. Now, in case of short term, you have two aspects. Either you list and then you exit. If you list and exit, then it is 20%. But if you enter unlist and you exit unlist in short term, then it will get added to your income. But what I have seen, I think the way we are structured, most of our exits would be long term in nature. You can safely assume that most of our exits should be long term in nature, which is 12.5%. But that is the rule as of today. You have the
Sure.
exit date that income tax rule will be applied.
Right. So, given that this is Series 3 and you have already launched the Series 4, right? Could you, highlight some of the key investments that are already a part of the Series 3?
So series 3, we have already done investment into the VR. I can do one thing. Immediately after this call, I can give you the newsletter for series 1, 2, 3. That probably you can share with the investors, because if I start talking on the investing company, it will be a very long drawn presentation. But again, most of the investing company matches to the presentation that I have given to you. So you can share the newsletter for series 1, 2, 3 with the investors. I'm okay with that.
Yeah. So, Darshanik, I think this question you'd like to take. That's related to the exits in Series 1 and 2, right?
The exits.
The exits in Series 1 and 2.
So basically, our series one also we started in 2022, but then let me tell you, it was an absolute struggle to raise funds in your first series. You know, it's a struggle to raise funds for your first series. So money came little late. So most of the investments have happened in 2024, even in series one, right? But we started our series one in 2022 April. We closed it for subscription in the month of October 2023. But our first exit that we gave was in the month of May 2024, which is exactly 17 months from the date of investment. Till May 2024, we had invested in 7 companies, and we had only called for 65% of the drawdown. So somebody investing 1 crore would have given us 65 lakhs. And out of those 7 companies, we exited from one, and we were able to give our clients 8.6 times of what was invested in that company. So out of 65 lakhs, 7 lakhs was invested in the company called Silver Consumer Electricals. In December 2022, we had invested. May 2024, we exited. So 7 lakhs became 60 lakhs, and we deducted TDS 10%, and 54 lakhs went back to our clients. So in the history of category 2 AIF, it has never happened that you have not taken the entire money and you have returned, almost 90% of the capital that was taken from them. And then in July, we had taken the entire money, and as of now, we have invested in 11 companies, out of which one we have exited. The second exit is due in the month or two. We had invested in a company called Vikran Engineering, based out of Mumbai. We entered this company in the month of January 2024 at a valuation of 740 crores. February we got the IPO approval, but since things were not so good that time, the markets were not that favorable, so we had to wait for an opportune time to launch the IPO. Maybe in a month or two we will, launch the IPO, and we will exit at an exit valuation of 3,200. Again, this is like a 3.5 to 4x kind of a story in 18 months. So as of now, these are the two exits that we have done. Third exit, effectively we have exited from the company, but we've gotten merged with a listed company. So what we hold now is shares of listed company, which again we are waiting for a right time to exit. But as of now, what we hold is the shares of the listed company, which we can exit anytime. So these 3 exits would effectively return our clients 120% of the capital that was invested. Remaining 8 exits will be only profits. Series 2 we started last year. It's not even a year now. We've already invested in 11 companies. That's what Nishad was also mentioning. We are not only fastest in raising funds, but we are also one of the fastest in deploying. So within a year, we've deployed in 11 companies, and out of those 11 companies, we are already filing DRHP for 2 companies. So it's not even a year. If we see most of our competitors, they would take 2 to 3 years time. Here we are talking of filing of DRHPs, right, for 2 companies. Third, we have just started in January. As of now, we have invested in 1 company, and maybe this month or max by next month, we are going to invest in 2 more companies. So talking, I saw one question. Somebody asked for MOIC as well. So for Series One, the MOIC as of now, as on 31st March 2025. Okay, since markets were not good that time, still the MOIC for a Series One was 2.6 times. MOIC for Series 2 is 1.3 times as on 31st March 2025. Series 3 we have just started, so it's very difficult to give you MOIC for that.
Sure. A very pertinent question, Nishad. How is this fund little different from a traditional venture capital fund?
Okay, without saying anything against anybody else, but this is not a startup fund. Certainly, we are not venturing into anything new. This is a fund which takes a bet on a well-established companies. Now, in Series 3, in fact, if you see the first company, we are has a 1,000 crore top line, PAT positive. Now, who has the shareholding? Promoter having 86% shareholding, I am having 13% shareholding. So, exclusive deal flow. If you see the venture capital, there are too many investors you will find. Relative amount of startup is there. The companies are not grown up. The exit is not year mark. Whereas these companies are, just about to go into the IPO. DRHP is not filed. So you are trying to avoid the lock-in also. The companies are grown up. Promoter is having substantial shareholding. So that's where the difference is very there, because as I said, exit is first and then the entry is signed. So that's the difference. Plus the shorter timeline. This is much different than and that is what the investors' confidence has reflected, because from April 22, as Dashnik has said, our fund investment and the co-investment, if I club both, then the asset under engagement is close to 7,000 crore shillings. So this is slightly.
Yeah.
Sorry, tricky question, because I cannot talk too much about the competition.
Yeah, I understand. That's fine. That's fine. A very interesting question. I am sure you will get asked this question very often in your presentations, right? So, given that you're a kind of a lead investor with the company, right? At any point in time, you mentioned around 10% of the capital is invested in. What if the IPO process gets delayed a bit? What if the DRHP filing, there are issues in that, some observations by the regulator? What happens in that case?
So, Sharon, that's where first of all, the expertise of the group comes into the picture, because we are not new to this industry. We are in this industry for 11 years. We have seen so many IPOs. So probably we have learned hard way what can go wrong on the date of exam, I would say. So most of the time, what happens? You ask me the differentiating factors. A private equity or a venture capital, they also grow their company, but the compliances are not taken care of most of the time. So even after growing the company, if you file the DRHP, and that times if the compliance issue come, you have to wait for 2 years. Whereas on the date of investment only, we start working on the compliance. As I said, in this fund, we are giving money for the compliances only. So the probability of happening of that event is there. But still, let me take this question, if should that event happen. So this is not the only clause that 30 months you have to go for IPO. So 30 months for the IPO, if that not happening, after 6 months, I can sell my stake to anybody. So then invariably here promoters come into the picture, because promoter having 90% would never allow me to sell my 10% to his competitors. So there the buyback clause comes. A buyback would happen. Every private equity has a buyback clause. But I want to tell all the investors, the promoter having 10% stake in the company, and if you are a buyback, sorry, but that's of no use. And promoter having 90% stake, if he wants to buy back, he has equity to borrow the money. So he can always pledge his equity, give his equity, and take new money and allow me to go out. So promoter having 90, my experience says the promoter having 90% clause, then buyback never triggers. And promoter having 10%, 20% stake, even if you have a buyback clause, it's of no importance. And that's what my experience says. If I'm wrong, happy to be like that, but I think everybody has experienced the same thing.
Yeah, so this question is, important from the point of view of the GIFT City route, right? So when it comes to your GIFT City fund, what's the taxation for the NRIs?
So what happens, sir? India, whenever GIFT City repatriates, since your underlying assets are in India, so that 12.5 plus surcharge plus GST would be deducted. And if you are in the US investors, because we have started accepting US investors also in GIFT City, you will be issued a K1. So in K1, for example, US you have 20%, that is a DTA between India and US. So we'll mention in K1 that say out of 20%, say 14% would be deducted in India. So you can take the benefit of K1. So in all the jurisdiction, we will give you account statement stating this is the tax deducted. Now as per your home country, if the DTA is signed, you have to take the benefit of that particular statement. But underlying asset is in India, so Indian taxes investors have to pay. And your local taxation, each country wise, it will be difficult on my part to comment, so that you have to consult your local. But jurisdiction like tax-free havens like Middle East, Dubai, Singapore, Hong Kong, you did not have to pay again and again.
Yeah, sure.
Because India has a DTA with most of the countries.
Okay. A good question from the point of view of the bonuses and the dividends and the rights, issued, right? So how are all these, what's the treatment for bonus, dividends, rights, and preferential allotment for the investors in this company?
So investors are basically issued the units of AIF, and which is my fund, and AIF gets the equity share. So this is not, since we have to go for a clear-cut exit, so except one company, rest all the companies we are given direct equity. There is no convertible bonds, quasi equity, partially convertible preference shares, fully convertible, that kind of instrument we are never result. This is a straightforward equity which we get. And in case if any of the investing company wishes to declare the bonus or the dividend, of course if the bonus comes, the number of shares to the fund goes up. In that case, the NAV of the investors as a impact goes up. And if any of the investing company gives us the dividend money comes to the fund, and whatever comes inside the fund as per the regulators belongs to all the investors in the ratio of your units. And if we get the dividend, we will pass it back to all our investors after deducting the TDS.
Now, any lock-in criteria in the AIF?
So technically, yes and no, both. So the way it is structured is that, say, for example, say you are holding a units of Bharat Value Fund or any AIF for that matter. So redemption before the expiry is not allowed. But if you want to do a secondary trade, then the PPM has a clause that you want to exit. You can exit by signing the deed of adherence, and that will be signed by, say, exiting investors, the new investors, the trustee, which is in our case the Orbis, and the fund management team. So these are 4 people signing the agreement for the secondary transfer of the units. So units will get transferred from, say, demat of the party A to demat of party B. That is officially allowed, but redemption is not allowed. That's why I said yes or no both.
Yeah, and Nishad, from the investment point of view, right? What's the maximum debt that any of the investee companies would have on their books across all the 3 series?
So series 2, though, out of 8 companies, 4 are net debt free and 4 are having debt equity less than 0.5. Only one company, I think we have more than one, but we're trying to bring it down less than 1. But technically, we also try to go for that debt free, because we are the series 3 of the first company is net debt free. Series 2 out of 8 companies, 4 companies are net debt free. Net debt free is working capital is there, term loan is not there. Current assets are more than current.
Okay, and what would be the maximum stake that you would take in any company at any point in time?
Except 1 or 2 companies, we have not taken more than 15% stake in one investee company, because that is easily exitable on the date of IPO. If you take, say, 30-40% stake in any investee company, exiting 30-40% stake on the date of IPO becomes very challenging. So take such stake which is exitable. So except 1 or 2 companies, rest all companies, the sweet spot is between 8% to 12%.
Understood. A very technical question that's come up. Can an investor pledge the AIF and raise capital in a bad market? So it's loan against the AIF.
So many AIF does it, but you need to find the NBFC to do that. So my series 1 and series 2, we were not allowing that. So we have to open that. And I think in series 3, we are taking a call to open because it has to be allowed by us. So we will allow it. If any of the NBFC is willing to give you the loan against my units, I have no objection.
Okay. And this question, the next one is very specific to Series 3. What's the average ticket size and the number of targeted deals in the portfolio companies that you're taking?
Average ticket size would be in the range of 175 crore to 200 crore would be there. And number of investing company would, as expected in Series 1, Series 2, would be 12 to 15. And 85% money will go into the unlisted. Up to 15% we take into the listed, just to maintain the liquidity in the fund.
Okay. And maybe this is the last question that we'll take. Yours is a very unique fund, right? It's pre-IPO, short tenure one. Any peers that you would have in the industry wherein you would like to benchmark yourself against?
Unfortunately, not Shulin. Maybe no, I don't. Sorry. Having similar credentials, I have not come across. If you have come across, I'm happy to know that. Maybe my investors can tell me. I keep on asking the same question to my investors also, just to get awareness. I am yet to come across. I stand corrected, but I am yet to come across. I put a bit disclaimer over here.
Thanks. Thank you so much, Nishad and Darshini. That was a very insightful session. A lot of detailing, a lot of differentiation as far as the product is concerned. I'm sure the investors have a lot of takeaways from this session. And if you look at the Q&As that had come up, very interesting questions, and you took out time to answer all of them in pretty much detail. So nice, insightful session. Thanks a lot for the detailing. For all the investors that are locked in, we do watch out for more of the Alpha Manager series, the new additions in this fiscal from all of us. Thank you everyone for logging in, and that concludes the session. Everyone, you may please log out. Thank you, Nishad. Thanks, Darshini. Thanks for
This was
for giving us
just
this.
an investor education and awareness session. Thank you very much. Thank you.
Thank you.